Today we're looking at something really fascinating, a contrarian case in the streaming world. We're diving into an analysis report that makes a very, very bold argument for Fubo TV. The ticker is, of course, FUBO.
Yeah, and for you, the listener, this is really a masterclass in challenging market perception. The market, it has a long memory, especially for tech companies that, burn through cash.
Right.
But this analysis makes a strong case that Fubo TV just isn't that company anymore.
And that market perception, I mean, right now it has the stock priced at around $2.56. If you just glance at that, you think, okay, typical speculative bet, a penny stock, basically, just hovering near its lows. But the analysis we reviewed, it presented this one single number that just completely reframes the entire investment thesis.
And that number is a price-to-earnings ratio, PE, of 7.14.
7.1.
Yeah.
It stopped the conversation cold.
It's an anomaly. I mean, in the world of high-growth streaming tech, you just don't see that. We're used to seeing PE ratios of, 50, 100?
Right.
Or more often, they're just negative because the companies are deep in the red.
So a PE of 7.1 fee, it suggests this company isn't just profitable, but it's priced like a utility. A slow growth value stock.
Yeah.
And that's the paradox.
Exactly.
So our mission today is pretty straightforward. Is this PE a glitch, a mistake the market's making? Or is it proof that Fubo TV is, like the analysis says, moving from a cash-hungry startup to being on the verge of massive profitability?
We really have to explore if this is, a profound, deep value asymmetry, where the price is just totally disconnected from the company's actual financial health.
Okay, let's unpack this. Let's start right there with that PE of 7.14.
Right. So most investors, they look at Fubo and they just instantly think of that old narrative, that they're losing money hand over fist.
And that's baked into the price. That's the $2 stock right there.
That is the $2 stock. But the analysis points to this profound data shift that is now, it's showing up in the financial reports.
And that shift, it all comes down to a really tiny number, doesn't it? The positive normalized earnings per share.
Correct. The company reported a positive normalized EPS of 2 cents in the most recent quarter.
Just 2 cents.
It's a small number, but its significance is massive. It flips the entire story. The company goes from a loss maker to an earner.
Wait, let's get into the math here for a second, because I think this is where a skeptical investor might get, hung up. If you take that 2 cents EPS and you just annualize it, that's 8 cents a year.
Right.
With the price at $2.56, that math gives you a PE of 32, not 7.15.
Yeah.
So where does the 7 come from?
And that is a crucial distinction. The analysis addresses it directly. That 7.14 PE, it's based on forward earnings estimates.
Oh, okay.
It's what institutions are projecting. They see these operational improvements continuing, and they're projecting a much higher EPS over the next 12 months, way more than that simple annualized 8 cents.
So the analysis is basically saying, if you believe the trajectory, if you believe their cost control and margin expansion is going to continue,
Yes.
then the company's going to earn a lot more, which is why that PE drops so low. It's a bet on continuity.
Precisely. It shows that sophisticated financial models are already categorizing this as a deep value play. But the market is still treating it like a company about to go bankrupt.
That's a huge conflict in the numbers.
It's the aha moment. We're looking at a $2.50 stock that is priced for failure, but it's being analyzed for growth and for value.
And if that disconnect wasn't sharp enough, let's shift to the price-to-sales ratio, the PS. For growth companies, this is often the go-to metric, right?
Yeah.
Because revenue is just easier to predict than profit.
Exactly. The PS ratio is simple. It just tells you what the market is willing to pay for every dollar of revenue a company brings in. It's a key health indicator.
And the sources show that FUBO is trading at roughly 0.5 to 0.6 times sales?
Yeah. I mean, that is nearly unheard of for a company in a market like streaming.
So to put that in context for everyone listening, you have to compare it to others in the same space. Look at a giant like Netflix.
Right.
They typically trade at 6 or 7 times sales.
So the market values $1 of Netflix revenue about 10 times higher than $1 of Fubo TV revenue.
It's a staggering disconnect. The analysis had this analogy that really stuck with me. Trading at 0.5 times sales means you are buying $1 of revenue for roughly 50 cents. You're getting their top-line earnings for half price.
What's fascinating here is the market is basically saying one of two things must be true. Either Fubo's revenue is about to just completely collapse, or the company is so inefficient that it will never, ever be able to turn that half-price revenue into actual cash.
But the whole argument of this analysis is that those fears are old news. They're based on the company's history, not its current operational reality. So if we look at the financial firepower, do the operations actually justify this kind of valuation?
They do. And this is where the conversation gets really meaty, the shift from just surviving to actually beating expectations. It's about real structural changes that support that forward PE of 7.14.
Okay, so let's start at the top. Revenue. It's holding steady, right? Pushing over $1.6 billion annually. And the most critical thing for a subscription business, the subscriber health is strong. They're still growing in North America, even after hiking prices.
Right, which suggests they have pricing power. The product is sticky.
And we know why it's sticky.
We do. Live sports content. Fubo has carved out this incredible niche as the go-to streaming service for sports fans. And in the streaming wars, live sports. It's the last real moat. It's the content that people feel they have to have, and it drives retention.
People will pay more so they don't miss the game.
Exactly.
So that explains the revenue stability. But the big threat has always been the cost of that content. It's notorious for destroying margins.
It is. So if they're really succeeding, we need to see it in their efficiency metrics. And we do. That brings us to margin expansion. The analysis highlights that their gross margins have climbed to over 12.5%.
That might not sound huge, but in this business, that's a major signal.
It's a huge signal of improving unit economics.
So how they do it? Do they just renegotiate all their contracts?
It's a mix of things. Part of it is negotiation, sure, but they're also getting smarter about which regional sports networks they carry. They're dropping the ones that cost a fortune but don't drive viewership. And second, the analysis hints at platform optimization. They're using their own tech to deliver streams more efficiently, which cuts down on third-party costs.
So smarter contracts and a better delivery system.
Every single percentage point they gain in margin is a direct counter-argument to that market fear that they can't manage their costs.
And that's what makes the positive 2-cent EPS even possible in the first place.
Precisely. And this directly tackles the third, and maybe the biggest fear, the company running out of cash. For years, every time the stock dipped, the rumor was dilution, that they'd have to sell more shares just to keep the lights on.
But if your margins are getting better,
you slash your cash burn rate significantly. And the implication is profound. They are moving toward being self-sufficient. And if a company doesn't need to keep tapping the bucket for cash, the floor under the stock gets a whole lot stronger.
Which leads us directly to the technical setup.
Yeah.
Because that structural floor seems to be showing up on the charts now.
It does. You can see it. If you zoom out to the yearly chart, the analysis confirms the strong technical floor right at the $2.28 level. It's not an arbitrary number. It's a level that has held firm.
And they describe it as a classic double bottom. So the price tested $2.28, found a ton of buyers and bounced. And then came back down, tested again, and bounced again.
Right. It confirms that level. It signals that sophisticated buyers see $2.28 as the place to own this stock.
And with the stock currently at $2.56, it's putting in what they call a higher low.
Which is just textbook reversal behavior. The sellers are getting exhausted and buyers are stepping in at slightly higher prices. The momentum is shifting.
So what are the key levels to watch? The report points to one critical hurdle right above us, the resistance at $2.60.
Clearing $2.60 is the confirmation. The analysis notes that once it punches through that, there's very little air resistance until $3. That suggests there aren't many sellers layered in between those prices. A move above $2.60 could accelerate quickly.
Here's where it gets really interesting. This is the element that could turn it from a solid turnaround story into a potential rocket ship. The short interest. The report highlights that 18% of the float is currently short.
18%. That is a massive number. It's a huge group of investors who have made a multi-million-dollar bet that this stock is going down.
But if the fundamentals keep getting better and the price crosses that critical $3 ceiling, those shorts are in big trouble.
They get forced to cover.
Can you explain what that actually looks like? For someone who isn't deep in trading dynamics, what does a forced cover mean?
It's panic buying, pure and simple. When the price moves against a short seller, they start losing money, and their broker demands more collateral. To close their position, they have to buy the shares back. They have no choice. So if $3 is breached, you have this huge forced wave of buying pressure hitting the stock.
And that's the squeeze.
That mass, non-discretionary buying is what fuels the massed rally, the analysis forecasts. It's a classic short squeeze.
So the operational improvements give the stock a floor. The technical setup provides the trigger. And the short sellers, they provide the fuel. It's like a coiled spring.
That's the entire thesis in a nutshell. The fundamentals say the stock shouldn't be here, and the technicals and market mechanics could amplify the correction.
So what does this all mean? We started by asking if Fubo TV is the most undervalued stock in the market. This analysis makes a very compelling strong buy case.
Well, the strength of the case is in that rare combination of factors. You have the forward PE of 7.14, a PS ratio of 0.6, and that huge 18% short interest just sitting there.
The report basically says this is a billion-dollar revenue company that's figured out its profitability problem. But it's trading for, as they put it, pennies on the dollar.
And just as important, the risk to reward is really well defined. That confirmed bottom at $2.28 gives you a clear downside risk level. Meanwhile, the upside, catalyzed by that squeeze potential, it's significantly higher. $3 is just the first major milestone.
The numbers are there, the operational improvements are confirmed, the technical setup is defined.
The immediate technical implication is crystal clear. The trigger for this whole thing seems to hinge on clearing that $2.60 resistance and forcing the short's hands at $3. But we always have to consider the bigger picture. Fubo's entire business model is built on live sports content. So the real question for you, the listener, to think about is this. How sustainable is this margin expansion if, say, Disney or Comcast decides to pull their sports bundles into their own standalone apps in the next 18 months? That external threat, that is the fundamental challenge to this otherwise incredible value thesis.
A truly outstanding deep dive into a very high-conviction contrarian case. We hope this gave you all the knowledge you needed quickly and thoroughly.